Okay, let's unpack this. You probably heard about dividends. Maybe you've even seen them show up on your investment statements. But understanding how those dividends actually impact your taxes, that can feel, well, less like simple math and more like trying to find your way through a maze.
It really can.
So today, our deep dive is all about decoding in dividend income and, really importantly, its tax effects.
Yeah.
Our goal here, cut through all that complexity, and give you some practical, useful insights. So you look at your investments with more confidence.
And what's really quite fascinating, I think, is how a distribution that seems so straightforward can end up being taxed in very different ways.
Right.
It all really hinges on how it's classified. So this deep dive should definitely help demystify some of that. It's pretty crucial for good financial planning.
Okay, so let's start right at the beginning. The basics. What is a dividend, really?
Fundamentally.
Yeah, simply put.
Okay. It's basically a piece of a company's profits. The tax folks call it earnings and profits that the company pays out to its shareholders.
So it's like your slice of the pie, your share of the company's success.
Exactly. And it's, the most common way corporations distribute value back to their owners.
Gotcha.
And this is where it gets interesting, tax-wise. Dividends generally fall into two main categories, ordinary or qualified.
Ordinary or qualified, okay.
And that label, that classification, it's a really big deal for how much tax you end up paying.
How so?
Well, ordinary dividends, they're taxed just like your regular income, your salary, at your standard tax rate.
Okay, straightforward.
But qualified dividends, those are kind of the golden ticket. They get special lower tax rates, similar to long-term capital gains.
Oh, okay. And how do you find out which is which?
Usually the company or the mutual fund, whoever paid you, will tell you on a Form 1099 DIV, you'll get this if you receive $10 more in distributions.
1099 DIV.
And if you're getting distributions through something like a partnership or an estate, you might see it on a Schedule K-1 instead.
Okay. So let's dig into those ordinary dividends first.
Right.
You said they're paid from earnings and profits, not capital gains.
Correct.
And the general rule is assume it's ordinary unless the company tells you otherwise.
That's a safe bet, yeah. For most common or preferred stock dividends, that's the default.
And they just get added to your income, taxed at your regular rate, no special breaks there.
No special breaks. Simple, but potentially higher tax.
Right. Now, this is where it gets really interesting. You mentioned qualified dividends. This is where you can potentially save some money.
Definitely.
So they're part of your total ordinary dividends, but they get taxed at those lower rates. What are those rates again?
Okay, so the maximum rates for qualified dividends are 0%, 15%, or 20%.
0%.
Yeah, 0%. If your overall taxable income doesn't go above a certain level, what the IRS calls the 15% breakpoint, your qualified dividends could actually be completely tax-free.
That's huge, especially for maybe retirees or lower income folks.
Absolutely. It's a really powerful benefit. Then, if your income is above that first breakpoint but not above the next one, the 20% breakpoint, you pay 15% on those qualified dividends.
Okay, still much better than regular rates for many people.
Oh, for sure. And only if your taxable income is quite high, above that 20% breakpoint, do you hit the top 20% rate on qualified dividends.
That sounds great.
Yeah.
But there must be some requirements, right? How does a dividend actually become qualified?
There are two main conditions, yes. You can't just assume.
Okay.
First, the dividend has to be paid by a U.S. corporation or what's called a qualified foreign corporation.
Okay. Most big companies traded here would count.
Generally, yes. Most common stocks and mutual funds you'd invest in typically meet this. The second requirement, though, this is often the trickier one. It's the holding period rule.
Holding period. Okay, what does that involve?
It means you, the investor, have to have held the stock for more than 60 days during a very specific 121-day period.
More than 60 days in a 121-day window. When does that window start?
It starts 60 days before the stock's ex-dividend date.
Ah, the ex-dividend date. That term comes up a lot. Can you break that down for us?
Sure. The ex-dividend date is basically the cutoff day. It's the first day the stock trades without the right to receive the next upcoming dividend payment.
So if I buy on or after that date, I don't get the dividend.
Correct. The person who sold it to you gets it.
Okay. And for counting that holding period, the more than 60 days, how does that work?
Right. You count the day you sell the stock, but you don't count the day you bought it. And that 121-day window, it starts 60 days before the X date, includes the X date, and then runs for another 60 days after it. So think of it as roughly a 4-month period centered around that X dividend date. Your holding period has to fall within that.
More than 60 days within that 4-month window, not counting the purchase day. Okay, that's critical. Let's try an example to make it clearer.
Good idea.
Say I bought, I don't know, 5,000 shares of XYZ Corp stock on July 5th. The ex-dividend date is July 12th. My 1099 DOZ later says I got $500 in dividends, and it says they're qualified.
Okay.
But then maybe I needed the cash, so I sold all those shares on August 8th. Now, how long did I actually hold them for that dividend?
Let's see. You count from July 6th through August 8th. That's 34 days.
Only 34 days. So even though the 1099 says qualified.
Oh, because you held it for less than 61 days. Remember, it has to be more than 60. During that window, none of that $500 actually qualifies for the lower rate.
It all gets taxed as ordinary income.
That's right. Your holding period overrides what the form might initially suggest. That's a common mistake people make.
Oh, okay, that's a big difference. Now let's change that slightly. Same XYZ Corp, same $500 dividend, same ex-dated July 12th. But this time, I bought the stock on July 11th, just the day before the ex-date.
Uh-huh.
And I held onto it longer, say, until September 13th. Now what?
Okay, so now you held it from July 12th through September 13th. Let's count that up. That's 63 days.
63 days. So that's more than 60 days.
It is. So in this case, because you met the holding period rule, that entire $500 dividend is qualified. You get the lower tax rate.
Just by holding it a bit longer. That really shows how timing matters.
It absolutely does. It's not just about getting the dividend check. It's about making sure you meet the rules to get the best tax treatment on it.
Makes sense. Okay, so we've covered ordinary and qualified, the main types. But you mentioned there are other kinds of distributions too.
Yes, a few others to be aware of.
Like what about dividend reinvestment plans? DRIPs, right, where they use your dividend to buy more shares automatically. You don't get cash, so maybe it's not taxed yet.
Ah, good question. But no, it is taxable income, even if you reinvest it.
Really?
Yes, the IRS treats it as if you received the cash dividend and then chose to buy more stock with it. So the amount of the dividend is taxable in the year it's paid or reinvested.
Even if you buy the stock at a discount through the plan?
Especially then. If you get a discount, you actually have to report the fair market value of the extra stock you received as dividend income, not just the cash dividend amount.
Okay, that's tricky. Good to know. What about money market funds? They sound like bank accounts sometimes.
They do, but they're different for tax purposes. Amounts you get from a money market fund are reported as dividend income.
Not interest.
Not interest. That's for bank money market accounts, funds pay dividends. It's a small distinction, but it matters for your tax forms.
Got it. And then you hear about capital gain distributions sometimes.
Right. These usually come from mutual funds or maybe REITs, real estate investment trusts.
Okay.
The key thing here is these are reported as long-term capital gains. Full stop.
Regardless of how long I own mutual fund shares.
Exactly. It doesn't matter if you bought the fund yesterday. If the fund distributes long-term capital gains it realized inside the portfolio, it flows through to you as long-term capital gains. And sometimes a fund might actually hold on to those gains and pay the tax itself. If that happens, they'll send you a Form 2439.
Form 2439.
Yeah, it shows your share of those undistributed gains. You still have to report it as a long-term capital gain, even though you didn't get the cash. But the good news is you also get to claim a credit for the tax the fund already paid for you.
Ah, so you get that tax back, essentially.
Right. You're not taxed twice.
Okay. And what about non-dividend distributions, sometimes called return of capital?
Yeah, so these are payouts that are not coming from the company's earnings and profits. Think of it more like the company giving you back some of your original investment.
So it's not income then?
Not initially. It reduces your cost basis in the stock. So if you paid $50 a share and you get a $2 return of capital distribution, your basis drops to $48. It's generally not taxable right away.
Until when?
Until your basis hits zero. Once you've gotten back your entire original investment through these distributions, any further non-dividend distributions are then treated as capital gains.
Long-term or short-term?
Depends on how long you've held the stock overall at that point. So it defers the tax, basically.
Okay, one last category. Distributions of stock or stock rights, like stock splits or stock dividends.
Right. Generally, those are not taxable. If a company just gives you more shares of its own stock, you usually don't report anything as income. Your basis just gets spread over more shares.
Usually. Are there exceptions?
There are. They become taxable in a few specific kind of anti-abuse situations, like if shareholders get a choice between receiving stock or cash, or if a distribution gives cash to some shareholders and increases the ownership percentage for others, or involves convertible preferred stock in certain ways.
So complex situations, mostly,
Yeah.
not the average stock dividend.
Exactly. For most investors, a simple stock dividend or split won't trigger tax.
Okay, phew. That's a lot of different types. So bringing it all together, what does this actually mean for people trying to plan their finances and taxes?
Yeah, how do you make this work for you? Well, the biggest takeaway, I think, is to really focus on getting those dividends to be qualified if possible because of those lower tax rates.
So pay super close attention to that holding period rule.
Absolutely. More than 60 days in that 121-day window. That's key.
What's a practical strategy then?
Be mindful of when you plan to sell stocks, especially around their ex-dividend dates. If you're thinking of selling shortly after getting a dividend, just pause and check that holding period. Selling a few days too early could accidentally turn a 0% or 15% tax situation into a much higher ordinary income tax situation.
That could be a costly mistake just for selling a bit too soon.
It really could. Also, for people whose income isn't super high, actively trying to stay within that 0% qualified dividend bracket can be a fantastic strategy.
Getting investment income tax-free.
Exactly. It might involve managing other income sources or timing sales carefully, but it can be really powerful, especially in retirement.
And underlying all of this,
Good record keeping. You absolutely need to know your purchase dates, your sale dates, how much you paid. Without that, you can't prove your holding period or calculate your basis correctly if you get a return of capital. Keep those brokerage statements.
right, so it's about being strategic with timing and keeping good records.
Precisely. If you connect this to the bigger picture, managing those holding periods, knowing your tax bracket, it seems like small stuff, maybe, but it can add up to real significant tax savings over time.
So the bottom line really seems to be understanding how your dividends are classified and knowing how things like your holding period affect that. It's just fundamental to smart investing and tax planning.
Couldn't agree more. This knowledge isn't just, academic. It directly impacts your financial well-being. It helps you keep more of your investment returns.
Makes sense. Well, that's certainly given us a lot to think about.
Hopefully useful insights for everyone.
All the best, and we will meet again with another important subject in the next meeting.